When you partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron.
Hello and welcome to Moving Iron Podcast Markets with Chip Nellinger out of Blue Reef Agri Marketing. He is nice enough to come on and talk about what's happening in the world of commodity markets. Chip, how you doing, bud?
Good. How you doing, Casey?
Yeah, pretty good, man. It is kind of an odd time right now. You know, it feels weird. Like there's just there's another shoe to drop someplace coming down the way. And if you look at what's going on,
I kind of agree with that. You can kind of almost feel it, you know. And I think one of the weird things is that, so we're coming up in a quarter, in a month, right? We got another stocks report coming out here next Friday. And if you take a look at what's going on right now with corn and soybeans, especially corn, if it gets close to $5, it loses 10 to 12 cents over the next week and kind of gets back down in that 4.90 range. Soybeans, they get up close to the $14 mark. They kind of work their way back down to that $13.85, $13.80, $13.90 type of range. I guess when you're looking at that, Chip, what's that telling you when you see that kind of sideways trading back and forth? Yeah, well, you know, I think first and foremost, corn and wheat have been trying to form a bottom, and you're right into the normal seasonal time frame where you can typically see that, especially in wheat. Beans, however, you know, they've had a recent puke here. That's a technical, market term is a puke.
Yeah.
And they puked back under 13. And so it's kind of telling you, on the one hand, it could make your brain say, oh, no, you know, maybe this is a big bean yield and we've got all this supply. On the other hand, though, to your point, you've got the end of the quarter coming. These funds, they get paid oftentimes either on closed positions on a monthly or quarterly basis. So, you know, in order to take their money and get paid their incentive fee, they have to exit their profitable positions and bank that money. And so they've been long beans and soy oil. They've been liquidating that right in time at the start of harvest here, when normally you'd see some harvest pressure. And so you're seeing a lot of, back and forth in these markets. Yesterday, 2 days ago, we had the Federal Reserve come out. They didn't raise interest rates, which kind of surprised me. I thought they would raise it a quarter of a point, but they were pretty hawkish, saying, "Hey, we're in no way thinking about going lower on this, right? We're either going to hold it steady or increase it going forward." And that really hit the financial markets pretty hard. It shot the dollar a lot higher. It kind of hit the stock market and the equities. We saw interest rates push into, I think, 20, 21-year highs. And that kind of weighed on the grain markets as well, and kind of induced this risk-off type mentality across the entire commodity sector. So there's a lot of push and pull in here. Harvest is starting. You're seeing some harvest, pressure in anticipation of that. And it's just leading to some really sloppy markets in here. And it's easy psychologically to get caught up and say, oh, no, these markets are no good. We're going lower. Beans are going to 10. Corn's going to 4. It doesn't help that there's some talking heads out there. And admittedly, I'm one of them, right? I'm a talking head as much as I don't want to be. but there's some talking heads saying corn's going to 4 and beans are going to 1080, and that's, in my opinion, kind of what you need to eventually put a low in here. And even in the biggest yielding years, you have bounces post-harvest in corn and beans both. So I think first and foremost, this is no place to panic. There's lots of volatility going on here with the outside markets and geopolitical stuff with Russia and Ukraine and the energy markets. And I just think this is no place to panic if you're a producer. If you're an end user, I'd be licking my chops a little bit here about getting some corn coverage. Again, over a 15, 30-year cycle between now and Columbus Day, first week in October, is typically your harvest low in corn, and then you put bounces into winter and spring. So I think you're, in the end result, really close to some longer-term lows here in corn and wheat, and I think you're within a days to a couple weeks away from maybe kind of an intermediate type low in the bean market too.
Yeah. When Chairman Powell talks and he comes out and says the things he says, like, hey, we're not going to lower rates, but don't get all excited that we're not going to, do whatever. It always reminds me like my football coach would be, hey guys, we're going to go, half speed, shorts and shoulder pads today. No, we're not going to kill ourselves, but we're still going to run. Right. And every time he says that, it just reminds me of those conversations like that, because he makes it very clear and with no hesitation at all. Like, we're going to probably lower it one more time. And if we don't do that, we're looking at a long-term holding rate.
Yeah. And it surprises the market is the funny thing, because he's been saying that for 2 years.
Yeah. It's like he's right. Back and forth, right? He's been like, we're going to 2%, and when we get to 2%, we'll stop doing what we're doing. And I don't care what it does to the economy. It's kind of what he says. And he's been a man of his word, I guess. He's been keeping it there, and he's not, like you said. I mean, I've read some like your talking head thing. You watch MSNBC and the business networks, Bloomberg, and all that stuff, and there are people that are betting their house and their kids' college funds that in the first quarter they're going to lower interest rates by 0.5 point. I'm like, have you not listened to one thing this guy said? And he's not wavered from that. And that's what kills me about how
and now the energy markets and the job market really are making his job hard, right? Like with that, I don't know. Again, I'm a Monday morning quarterback, right? But that does not make his job any easier because, unemployment continues to shrink. Now, on the one hand, maybe that's people getting second and third jobs, right? Because this inflation thing, I'm telling you, it is a bad deal. And the energy markets, diesel fuel and crude oil and unleaded gasoline to a lesser extent continue to rally. That's not even factored into the most recent inflation report we got. That's still a month ahead of us.
Yeah.
And so this inflation thing isn't going away, and it is not getting any better. There's only a limited supply of housing, right? I mean, if my mortgage is at 2.8%, I'm not in a real rush to go buy a new house when it's going to be 8%. And so that just kind of leads to this whole, it's like pushing a beach ball underwater. You can only hold it there so long, and it goes shooting out, above the water. And so I would not want his job. I don't know how he doesn't have some severe ulcers and a lifetime supply of Maalox or something.
I'm sure you've got something somewhere.
Or whiskey or combination of both. I'm not sure.
Combination of several things, I'm sure, to make that work. But yeah, you're right. I mean, I look at this. So, let's talk about the energy market here a little bit. So when you're looking at what's going on there, you have the stuff Saudi Arabia is doing about cutting supply, trying to do what they do. Russia came out a couple of days ago and said, hey, we're not exporting any more diesel fuel or oil out of Russia right now. You've seen that rally up. Right now, I haven't looked at the ticker or anything I heard this morning, but I think yesterday oil closed up 15 cents, if I remember right, something like that. And they're what, 91 or $2 or $3 a barrel, So that's all the way down from $68 just 2-3 months ago to where it's at now. You've seen oil really take off and run. And that, like you said, that's going to put some strain on an already fragile economy that we're looking at.
Yeah, absolutely. And that was, I don't know. We've talked about this before, Casey. We could do a whole podcast on it. One of the biggest bungles ever, which leads you to around the circle, the dog chasing his tail, to say it was exactly what they wanted all along, with reducing the strategic reserve. It's at 30 or 40-year lows. Saudi Arabia, they had every chance in the world to refill that $20 a barrel lower. They didn't do it. Saudi Arabia starts cutting production. The market rallies. Now Russia, almost seems like maybe Russia and Saudi Arabia have a back channel and talking. Let's really put the pressure on these guys. And then, the ban from Russia as far as exporting oil and diesel fuel. And yesterday, with the entire commodity sector, the dollar shooting way higher because of the Federal Reserve, talk of we're going to keep these interest rates higher for longer. Crude oil is maybe only one of the things in the whole commodity sector that closed higher. It's up another $1.60 today, trading north of $91. A lot of people think that's going to 100. I can't help but think, by the way, as you kind of circle back, that isn't going to breathe some renewed demand domestically, if it hasn't already, into corn and beans, right? We've got this huge renewable diesel industry that's kind of just getting off its feet. It's still crawling, trying to walk. And then we've got, a very mature ethanol industry, and these higher, energy prices, I think, are really breathing some nice profitability into there as, these plants are able to kind of buy this break, and their margins are really good on the backside of what they're, hedging in the energy market. So I think that's a demand story that maybe the market isn't thinking about right now in the grains, but it's also a real problem from the inflation standpoint, and, eventually is going to have its say in the economy. I'm a big believer of that. It hasn't on paper yet, but I can just tell you, it's, I went to a little small town cook your own steakhouse a couple weeks ago, and they had a chalkboard with all the specials, and they had, a little notice on there. Hey, we apologize. Our suppliers raising their price of beef. We hate to do this. We'll lower it as soon as we have the chance. 12-ounce ribeye, $41. Now you got a salad bar, a good salad bar, and a baked potato with that. But this is at a small town, out in the country, real USA, and it made you like, hey, man, do we need chicken or a burger here? $41 for a 12-ounce ribeye. And so there's no way that doesn't eventually filter through the economy. And like I said on this jobs thing, it continued to shrink the jobless, and the job market is very tight. And I don't know that that's not because of people having to get second and third jobs to try to make ends meet. And all the data out there also indicates that, people have tapped into their 401ks. People have exploded credit card debt, home equity. That takes a while to sift through the economy. And unfortunately, the consumer may be getting about tapped out to where there's no more sources of capital to them. And then you start seeing the effect of these higher interest rates and this inflation. And I don't mean to be a gloom and doomer, but I just, you can see some dark clouds right out to the west of us right now.
Yeah. No, you're right. I mean, you look at everything. I was playing around looking at some stuff the other day, and I was just like, if I wanted to buy my same house today, on the marketplace, what I paid for this one, blah, blah, my payment was almost double than as it was right now, just because of the way the interest rates are. And, it's going to be tough to watch how this thing plays out through the end of the year. And I keep hearing this, 24 is going to be good, and I don't think it's not going to, I don't think it's going to be bad, but I don't think it's going to be gumdrops and candy canes. There's going to be a lot of headwind ahead of us when they start interest rates and inflation by themselves are going to have such a play until that stuff gets figured out. It's going to be tough to keep things moving.
And I don't think that means that it's going to be bad in ag necessarily. Usually ag
I don't think so.
Is kind of the last one. Once the dominoes in the economies kind of start falling, ag is usually the last one. So I think from an ag standpoint, we could 23 is going to be okay. Obviously, prices are down. I think you're going to see bounces to be able to sell. I think 24 it could be good. You still have some weather issues in South America. I mean, everyone just, and myself included, you think, oh, we're just going to have this massive crop in South America and the never-ending record yields in Brazil, but they've got some issues down there as far as weather goes. It's too early to put much stock into it, but come January, February, that could be a different story. So there's some things that could still be good for ag, even though this general economy looks like we're it's like Wile E. Coyote and he's off the cliff right now and doesn't know it yet. And so what happens then? The anvil lands on his head when he hits the bottom.
Very sharply. Yep. All right. So what do you think about this? And give me your opinion on how the market's going to react to this. So the second ship has come out of the Black Sea now, since they've done away with the free shipping lanes in and out of the Black Sea. How do you think what's the market going to need to see out of that to really move the needle, you think?
Yeah, that's an interesting scenario, right? That has been a little bit negative to the wheat market. Some smaller ships have loaded, a couple of them, it looks like, some small amounts of wheat. It looks like there's some sort of a shipping lane that the Ukraine Navy has formed. Ukraine and Russia have been kind of very active, very aggressively bombing strategic shipping channels, right? And export facilities. And it seems like the grain market, the grain shipping has been front and center in this war. So it's seen as a little bit negative. I don't know that the market knows how to handle it just yet. Certainly there's some supply in Ukraine that could be exported that's really having a tough time. I read this morning that their August exports are about half of what it was a year ago. And so not that they don't really necessarily have it, they just, Poland and Eastern Europe is not real happy about Ukraine dumping grain on their shores, and yet they can't ship it out of the Black Sea. To me, it's like a sitting duck. I would not want to be working on any of those ships, man. I hope they're getting some hazardous pay because, those ships, I'm sure you've all seen them. They don't move very fast. They're sitting ducks out there. I would think that, Russia's licking their chops as potential targets, and we'll see. I mean, I hope it doesn't come to that, but that's what concerns me. But it does look like there's a couple that, one at least, that has made its way back through the Black Sea, and there's one that's kind of loading currently. And so, in the same breath, Russia just has no interest in redoing that agreement. There's been multiple attempts at trying to get them back to the table. They're just like, no. I mean, their condition all along is, man, you put us back into the SWIFT system so we can move money back and forth in the financial system. And until that's agreed upon, they're not going to agree to a Black Sea grain corridor again, it seems like. So I think the wheat market is so just weary of these every day, multiple times a day headlines. It's almost like I don't know how to handle it, right? And that's really kept a lid. We've tried to rally the wheat market a couple times now, and maybe still in the process of bottoming in this, but there's so many questions out there. It just seems like there's multiple kegs of dynamite out here in the world, and all we need, unfortunately, is one of them to get the fuse lit, and you could see a huge explosion higher in wheat. I'm not talking $3 higher, but a buck and a half higher in wheat if one of these powder kegs blows, just because the funds have a massive short. You're towards the end of that seasonal time frame where you normally put a low in and rally into the end of the year here, and all you need is one little spark, I think, and all these funds run for the exit. Again, you mentioned earlier you get the end of a quarter coming, so it's going to be an interesting week ahead of us to see what the attitude of the funds is going into the quarter.
Yep. Yeah, it's going to be that, and I think. What's your thoughts? they're going to, on this report that comes out, do you think USDA is going to make some changes, or do you think they're going to leave things alone?
Well, the thing to remember, a lot of people get confused about these quarterly stocks reports. So this is not the ending stocks, which we put out here a couple weeks ago on the monthly WASDE reports. That's a prediction of at the end of the marketing year, here's what's going to be left. These quarterly stocks are what is currently in the system, in storage, in transit. Now, it just so happens that this September one will be our final old crop carryout because the marketing year is over. And so whatever is there as of the 1st of September, that is what is left for our old crop stocks. And they're very hard to peg. And so sometimes there's a lot of volatility around these quarterly stocks because the unknown is, we know to the bushel almost what we've exported because that gets put out every week. What we don't know, and we know what we ground for ethanol, what the crush was on beans. What we don't know are some of these kind of unknowns, particularly feed usage on corn, and then some of the industrial, residual uses, so to speak. And so it makes these reports really hard to gauge and predict, and it opens the door up for big surprises. I think based on where we're at on prices and based on kind of the psychology of the market right now, I would think that the market in general would think that maybe the stocks numbers could be a little bit higher, meaning that demand wasn't as good for corn and beans and that these stocks numbers could be a little bit higher than expected. The shock will be if it's not. And there's some argument that on the feed side that the USDA has been understating that on corn all year. That is one argument. We'll see. It'll give us our final tally for whether the USDA was close or not on these demand projections. So this one in particular, the September stocks report, opens the door up for big surprises. Also, the end of the quarter. Also, we're getting, we're not, you're probably 10%, 12% along in corn harvest and maybe approaching 10% on beans. Got some rain around the upper Midwest, slowing things down a little bit. But, once you get to about a third, half done with harvest, a lot of times the market's made its lows. So it's just going to be an extra volatile day next week, and then throw on top of it any headlines we get out of, Russia, Ukraine, economy. It's really a crazy time in these markets with all that's going on and affected. We talked about that for a couple of years now, but it just makes it that much more difficult to figure out what's going on out there.
Yep, for sure. All right, Chip, probably a good place to stop. If folks want to reach out to you and get more information about what you're doing over at Blue Reef Agri-Marketing, what's the best way to do that?
Yeah, best way is just give us a call. 309-550-7213 is our main office number here in Morton. Be happy to chat with you. If you're bored out there going back and forth in the combine and worrying about the markets and your risk management plan, don't hesitate to give us a call. We'd love to chat with you.
Right on. Chip, appreciate you being on the podcast. We'll talk to you next week.
All right. Have a great weekend, Casey.
Thanks, man. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Go to LinkedIn, the Moving Iron Podcast, and go over to the Moving Iron Podcast YouTube channel. So brace yourself, folks. It's a very creative name, the Moving Iron Podcast YouTube channel. Check that out. If you see everything we're doing over at Moving Iron at MovingIronLLC.com, you can see all the stuff that we've got going on there. So check that out. So with that, I'm Casey Seymour with Chip Nellinger. Let's go move some iron, folks. Out.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here. Moving